big part of that is the first E, the environment, and the energy sector is a huge part of where such investment takes place. I'm also partly wearing my Scottish hat as well, because I'm delighted to have representatives from Aberdeen Standard Investments as speakers today, who are headquartered in Edinburgh, my own hometown. So wearing both hats really. Originally, we had envisaged at CBBC to organise a whole raft of activities and a report in advance of COP26, the UN Climate Change Conference, which was set to take place in Glasgow in November this year. As you'll all be aware, that has now been postponed due to the COVID-19 outbreak, and it has been postponed for a whole year back to the 1st to the 11th of November 2021. We do look forward to engaging with that as an activity next November, but in the meantime, it's still very timely for us to be talking about ESG investment at this time of global economic crises, and at a time where there's a huge amount being talked about the prospect of a green recovery from this economic crisis. On July the 9th, the International Energy Agency will host a summit, which will be the only major meeting of governments this year about climate change, because of the postponement of COP26. And it really is incumbent on governments and indeed the private sector to look at this opportunity, because it is an opportunity for a restart, to bounce back, but in a greener way. In April, the global emissions dropped by 17%, and it would be easy for governments to embark upon large-scale infrastructural investment programs of a non-green way. And I think it's this topic that we're here really to discuss today. And to discuss this with a great deal more expertise than I, I'm honoured to invite our first speaker, who will give us a presentation of about 15 minutes before we have two more speakers later, and then a panel discussion. So David Smith is our first speaker from Aberdeen Standard Investment. He's head of corporate governance based in Singapore. His main responsibility is to lead the engagement with members of the board and management of companies invested by Aberdeen Standard Investments in Asia. And in this role, he spearheads ASI's public advocacy on ESG issues. He represents the company at the Asian Corporate Governance Association, and leading international organization dedicated to improving corporate best practice, and has appeared frequently at regional conferences, roundtables, and has written a number of papers on this topic. Day to day, David is an integral member of the regional equity team and works closely with our head of stewardship in the UK, who we will also be hearing from later. And David is a CFA charter holder and has a PhD in corporate governance and an MA in corporate strategy and governance from the University of Nottingham in the UK. David, without any further ado, I'll hand over to you to set the ball rolling before we come back to hear from other speakers. Thank you.
Sure, thank you very much. And it seems as though you can't hear me. Please do nudge. I'll endeavour to lean into the machine so you can see and hear me. So by way of background, I work on the equities team at Aberdeen Standard Investments in Singapore, looking at Asian equities. My remit is broadly ESG for Asian equities, but also on top of that, I lead our regional utilities research. So not only do I get to see what's happening in China up close in terms of the fundamental market, we also get to see up close the dramatic change in not just ESG, but also decarbonization within, for example, the utilities sector. So I'll talk a little bit today, excuse me, about the evolution of ESG in China. And I will sort of bookend my comments by looking rather selfishly at when I first started looking at China. So I've been researching and investing in China for about 15 years now. So I'll begin my comments with a period of time from around early 2000s and up to today to assess that evolution in corporate governance and ESG more broadly. Most of my comments will relate to E and S and G, although I point as to one fact as being illustrative, and that's the fact that China is simultaneously the world's largest emitter of carbon dioxide, albeit on a gross basis, and probably the world's leading champion for environmental change. And that just shows the dichotomy around the environmental issues in China. I'll clarify at the beginning that my comments relate broadly to the country, and that means that to an extent they will take into account companies listed both onshore in China and offshore in, for example, Hong Kong and the US. But many of my comments will relate specifically to those listed onshore, so the A-share market. So if we go back to China in the early 2000s, again, when I first started to look at China, we see a market that is arguably less focused on ESG and arguably more focused on national development and GDP growth. Now, there's some fairly broad generalizations around here, but if you go back to the early 2000s, you see this focus on development and GDP growth. If you look at the company mix of the type of companies that we see in China, we tend to see a greater proportion of companies being SOEs, and SOEs are typically heavier industries versus the privately owned enterprises. In terms of the economy, we've seen at the time more focus on fixed asset investment and infrastructure building than on the knowledge economy. So those are two structural issues, I suppose, at the beginning of my time comparison that may lend themselves to arguably less focus on ESG. And if you look at capital markets, you've seen a very early days in terms of dialogue with institutional investors, maybe less orientation around the expectations of capital markets participants, far less frequent and deep dialogue with investors. And generally, when we talk about dialogue and engagement, I would say that in the early days of the market, and probably to an extent today, China was a market with high levels of information asymmetry. So investors didn't know much about companies or doing business in China. Chinese businesses that we met during our due diligence trips didn't know much about investors or what to expect from us or what investors might want. And so that led to a high degree of uncertainty on both sides. And where you have that high degree of information asymmetry and high degree of uncertainty, you don't necessarily get the deep and free-flowing dialogue on issues around ESG. So if you go back 15 years, very nascent in terms of development of ESG, discussion of E or S or G factors within Chinese capital markets. And if you go forward towards today, taking a sort of giant leap in China of 15 years, we're seeing this evolution now in terms of ESG. We're seeing a development in terms of the discussion of these factors, and we're seeing this for a number of reasons. And we're also seeing much greater and much better dialogue between companies and investors on these issues. So if we look at the development of ESG in China, there are two big macro themes that I would point to as being indicative of this development. And when I think about ESG, I tend to think about macro and micro themes. So you can think about macro themes as being these big policy changes, these big changes in the economy around, for example, renewable energy or access to healthcare or financial inclusion or whatever these big macro themes are. And then micro themes. So those are themes that sort of affect companies more specifically around things like relations with employees or supply chains and so on and so forth. So if we look at two big macro changes that we've seen in the last 15 years, the first one that I would point to is probably the cleaning of China. So the last 5-10 years, we've seen this focus on clean China, on green China, and we've seen this focus on waste management, waste treatment, hazardous waste management, environmental treatment and restoration, water treatment and restoration, and so on and so forth. So you've seen this focus on ensuring that, for example, effluent discharge into rivers is severely controlled versus what it was 10, 15 years ago. We're seeing much greater focus on emissions from power plants and heavily carbon-intensive industries. We're seeing focus on discharge of poisonous chemicals. We're seeing focus on discharge of poisonous gases. And that's been a really strong focus that we've seen in China over the last 5 or 10 years. So that's the cleaning of China. The second theme that I would point to is what I would call the greening of China. And this is the sort of overall decarbonization of the economy within China. And there are two major segments of China that we're seeing this in dramatic effect in China. The first one is utilities. So we're seeing China, which has long been seen as a power sector heavily dependent on fossil fuels, make really quite dramatic investments in renewable energy. We're seeing investments in solar and in wind. We're coming arguably to the tail end of investments in hydro, but we have seen fairly substantial investments in hydro in China. We're seeing at the same time a reduction in dependence on coal, a reduction in fossil fuel power station capacity, and we're seeing, as a result, China leading the world in electricity production from renewable energy resources. So people will point to the number of coal-fired power plants in China, for example, when they talk about the environmental challenges in China. But there are two caveats that I would point to around this. So one, China runs arguably the most efficient coal-fired power plants now in the world, and we can argue and debate and generally agree on the issue around thermal coal in terms of environmental degradation. But Chinese coal-fired fleet has been systematically improved and upgraded such that the efficiency of these plants is world leading. And secondly, we're seeing capex into renewables be extremely substantial, and in many cases outweighing capex into fossil fuels. So if you look for a leading indicator into the way that the utility sector is developing in China, don't just look at the installed power generating capacity, but look at where capex is going. And generally, you're seeing very substantial, in many cases, a majority of capital expenditures going to renewable power. At the same time, we're looking at a decarbonization of transportation. So we see this most markedly in electric vehicles, cars, buses, trucks, and so on. And we're seeing the Chinese government be incredibly supportive in terms of policies and subsidies for both the asset level and R&D in terms of making that transition from internal combustion engine to electric vehicles. So China already leads the world in terms of electric buses, for example. And it's not just utilities or transportation. We're seeing decarbonization across many other parts of the economy as well. So, for example, coal to gas switching for households, so switching out of coal consumption for residential units and towards gas consumption for residential units. But the other point I would make around this decarbonization and the clean China, green China themes that I've mentioned, are that this is not just happening at the end user state. So it's not just the power utilities themselves that are part of this theme. It's the entire value chain as well. So we've seen the utilities sector decarbonize or make these huge moves to decarbonize and increase energy efficiency. But China's identified clean energy as an industry that it can lead the world in, and has spent money on solar and wind technology all the way along the supply chain. So not just in terms of solar power generation, so the solar farms, but also that value chain, so solar modules, as well as EV technology. So not just the EV manufacturers, but the components as well. So battery manufacturers in China as well. So we're seeing this not just in terms of the sectors decarbonize, but we're also seeing opportunities and a transformation around those supply chains within China as well. So what's driving this overall move towards the two themes of clean China and green China, and a generally greater acceptance of ESG factors, and I'll come to the S and the G later. We're seeing a large part of this driven by government policy, so we're seeing very strong support in China for, as I've mentioned, clean and green China, so big support in terms of subsidies for both end users and upstream R&D. We're seeing, as it speaks to the relationship between investors and companies, we're seeing the opening up of the stock market onshore in China, first through QFI and then through Stock Connect. And that onshore access, and you can see the increase in the number of global investors investing onshore into China, has increased necessarily the dialogue between onshore companies and global investors, many of whom now are focused on issues around ESG. And we're also seeing in China a greater acceptance of the materiality of ESG issues in terms of the financial impact of those issues. So as the Chinese government has embraced these ideas of green China and clean China and cleaning China and decarbonizing China, for example, you're seeing that behaviors from companies have had to change as well. So you're seeing stricter penalties for and greater enforcement of these penalties for emissions, for example, or discharges into rivers. So companies now see, as a very sort of narrow example, that if you continue to pollute a river near your factory, then you'll be fined, and this is a business critical issue because after a number of fines, then you could well go out of business. So we're seeing this greater acceptance of the materiality of issues around ESG from companies as well. So what does this mean for investors? Just a quick word on us as investors in terms of the environmental changes we're seeing. It's presenting a lot of opportunities for investors, and obviously there's a lot of excitement around these clean and green China themes for investors. But it also needs a lot of research. It's challenging at the best of times to invest in themes rather than companies, and at Aberdeen we much prefer to invest in companies than themes. But particularly when it comes to renewables and this decarbonisation theme, it's very difficult to take a very broad approach. It requires a lot of research and a lot of on-the-ground due diligence. So when it comes to renewables, we like the theme of renewables, but it's one that requires a lot of research. We like the themes around electric vehicles, but it's one that requires a lot of research to get access to. We do like themes around energy efficiency, for example, and that's been a really interesting one for investors to see this overall development in China towards energy efficiency. And I'll give you one very narrow example of the way that investors have been able to look at this, and that's around data centers in China. So a number of years ago, we did a lot of work on data centers in China, and it's very clear that given this pivoting of the economy towards information technology and communications, that data centers were going to become an increasingly important part of Chinese infrastructure. But at the same time, data centers were incredibly power intensive institutions. And it was clear that the Chinese government would put stricter and stricter requirements around data centers and increasingly restrict the proliferation of data centers, particularly around city centers. And it was our view that if you could identify the most efficient data centers, those who had the lowest power usage efficiency, PUE stat, they would stand a good chance of being long-term winners in China, given this focus on energy efficiency. And it seems to be that's the way that the market's playing out. So renewables and EVs an interesting theme, but one that investors have got to do a lot of work on. But energy efficiency is a really interesting theme for investors, and one that you can have a lot of interesting conversations with companies on. So on top of the environmental issues, we're seeing a lot of progress on the S and the G fronts as well. So on S, I think one development that we've seen over the last, let's say, 15 years is attitudes towards and relations with workforce, for example. So if you were to look at, if you were to speak to companies 15 years ago and ask them about workforce relations and employee engagement surveys and so on, you would probably see fewer of those than you do today. And there's been a bunch of reasons for that development, but a notable one has been this transition towards knowledge economy and particularly IT sectors. And we've seen this incredible race for talent in these sectors, and that's driven a much greater awareness of the importance of fostering good relations with your workforce, and being seen as a very attractive employer in order to continue your competitive advantage. So we've certainly seen, and that's proliferated across the economy. So we've certainly seen that be quite a material change in terms of the S in China in the last 15 years. And also on G, we've seen much greater awareness of expectations around, for example, treatment of minority shareholders, more awareness of investors' interests around related party transactions. So the tension, if you like, between a majority shareholder and a minority shareholder, and the related party transactions that go with that, are a part and parcel of investing in China. And as investors, we have to get comfortable with that. But what we've seen over the last 15 years is a much greater awareness of why we're asking questions around these relationships and related party transactions. And one example I'd give there is the state-owned enterprises, state-owned enterprises group finance companies. So these are in effect a sort of central bank of state-owned enterprises. So many SOEs will have a central finance entity that the OpCos will deposit money with and take loans from. And we've certainly seen far greater engagement on that issue with companies now going to much greater lengths to explain why that's beneficial to the company and therefore to investors, and also explain the risk mitigations that they put in place. So that's one narrow example, but we've seen a number of similar examples where we've seen a much greater willingness of companies to engage on these G issues in terms of the dialogue with investors. When I talk about dialogue, and I'll wrap up my comments now because I think I've gone a little bit over my time, we're seeing much greater dialogue between investors and companies in China. And to an extent, we're seeing much greater trust between companies and investors in China. That's certainly true of those that have a longer term perspective, both in terms of companies and investors. We're seeing probably greater trust now through that familiarity of discussion. So we've been investing in China for a great many years and doing due diligence in China for an even longer time. And we're seeing that trust that we're not in this for a quick buck, that we are looking for a mutually beneficial relationship. And we've been able to show that we're interested in this sort of win-win discussion with companies bringing our perspectives from other markets, rather than just an annual criticism by letter that I feel that they may have used to have got in the past from some investors. So other investors are perhaps feeling this as well, but certainly from our perspective, we're seeing far greater openness to and far better quality of dialogue around engagement with companies on these ESG issues. It's not easy and it takes time to build that trust, but it's something you've got to work on, and we're very pleased with the way that that's gone. So to recap, we've seen this big evolution in terms of the E and the S and the G factors in China, some driven by the government, some driven by changes in the economy, some driven by an opening up of capital markets. And we've also seen much greater dialogue between investors and companies as well. So both of these facets we think are extremely helpful for the Chinese economy and Chinese capital markets more broadly. So I'll leave it there. I've rattled on a little bit over my time, I think, and we can expand on some of those points or topics as part of the Q&A. So thank you very much.
Thank you, David. That was an excellent starting overview for us all, especially for some of us perhaps with less of an insight into the involvement of ESG issues in China already. So we'll come back to you with questions in a short while. But first off, I'm going to hand over to our next panelist, Simon Horner, who's the Innovation Director at the City of London Corporation, where he focuses on sustainability and technology, and has worked in financial services for a dozen years, and in his current role has done quite a lot with China. And I think London Stock Exchange and the City of London have done a huge amount in bridging that gap between the UK and the Chinese financial markets. So, and in 2018, Simon was a co-author of UK-China Green Finance Task Force report on delivering for a greener tomorrow, which looked at a variety of issues. I can highly recommend it, including the greening of the Belt and Road Initiative, which might be something else that we pick up on. But over to you, Simon, if you just want to give us a few thoughts, describe some of the activity you've been involved with between City of London and China.
Great, thanks James, and thanks David for that introduction as well. That's a really helpful scene setter from my perspective. As we've talked about, I mean, the City of London Corporation has been working on green finance, specifically in partnership with China, for a number of years now, really looking at how we can get more cross-border capital flow, but actually slightly more profoundly than that, a kind of UK-China global leadership platform on green, whereby we're sharing best practice. We are, what starts with Shanghai Stock Connect, a really important initiative to connect to capital markets, but also providing a lot of the policy support and frameworks that can contribute to an initiative like that. So that's where we come from. I'll mention three key initiatives that we've worked on in the last few years that I guess kind of sit upstream a little bit of where David is working. So our thinking is to try and create better market conditions for the likes of Aberdeen to do their thing, basically, to make it easier, more predictable, more straightforward. A lot of what we do concentrates on capacity building and information sharing in the Chinese market, and I'll touch on a few of those opportunities now. So three of the projects that the UK-China Green Finance Task Force effectively birthed then. So one centres on the task force for climate-related financial disclosure. So that's the big project led by Mark Carney and Michael Bloomberg, which colleagues from Aberdeen will be extremely familiar with. What we've worked on there really is a pilot program between UK and Chinese financial institutions to share best practice as they move towards preparing their first disclosure reports under TCFD. We've put forward, certainly from the UK side, some leading asset management firms who are quite progressive on TCFD, looking to file their kind of disclosure reports straight out the gate, but partnering them with Chinese financial institutions to share information on what good looks like in the space, try better to understand constraints for Chinese asset managers, for example, and unique local challenges to TCFD compliance and disclosure, but also some advantages. For example, the Chinese legislative framework demands more from corporates in China in terms of mandatory disclosure, and we may end up there in the UK or in OECD markets as more generally, but certainly the Chinese have led in making demands from their corporates. The pilot program was about really enabling Chinese financial institutions to share best practice with the UK, ask the right questions and make the right demands to improve disclosure, which is obviously key to mobilizing capital. The second project I'll mention, James, you touched on greening the Belt and Road. I think that's a really key initiative for us. Obviously, if you look at the scale of the Belt and Road Initiative, and then you look at the commitments that particularly OECD countries have made under the Paris commitment to meet 2-degree scenarios, unless we green the Belt and Road effectively, it really doesn't matter what the UK does on climate or what France does on climate. Will globally miss the 1.5-degree target by a country mile unless this massive infrastructure undertaking has green principles at its heart. So that's why we co-authored with Chinese colleagues, PBOC in particular, but also with support from the World Economic Forum and others, the Green Investment Principles for the Belt and Road. They were launched at the Belt and Road Forum by President Xi, I think, coming up to 2 years ago. And at the moment, we have 37 signatories from 14 countries who are currently signed up to the GIPs. and we are working on our first annual report, which will essentially disclose progress against the principles or compliance against the principles. It's partly, I think, about risk management and disclosure, but partly those principles are also about business development and economic opportunity. We want to use the principles as effectively an investment platform. So compliance with the principles is step one, but of course, actually what we want is to bring more providers of capital into the fold to access the deal flow that the green investment principles can generate. It starts, of course, with banks and debt, but equally this conversation is really important for the asset management community and bringing global asset managers into the ESG opportunities that Greening the Belt and Road should present. Obviously taking on traditionally later stage involvement in BRI projects, but the opportunities are certainly there, and this platform should be a gateway to those projects. The final piece I'll mention was a big project we did under the UK PACT programme, which is run by the UK's Department of Business, around scaling responsible investment. And really it comes back to lots of the things that David mentioned in the ESG space in terms of market maturity and understanding, and the kind of what needs to happen next to really kick on ESG development. In particular, we tried to target Chinese asset owners in that space. So the likes of Ping An, for example, were heavily involved in the project to try and understand actually their perspective on ESG, what they are looking for downstream from the asset management community. In particular, I think more ESG investment products in fixed income, passive equity and private markets, for example, was a big finding, and you might argue a relatively quick win for the community to solve for. And obviously Chinese asset owners are sitting on significant capital, so the opportunities there. And we've also talked already this morning about stewardship. So the importance of stewardship and governance in realizing value and driving innovation. I think one conclusion of the report is whether there is merit in the UK partnering with China on developing a stewardship code that specifically speaks to the space, delivers again what those global asset owners based in China and elsewhere want from the market, and allow them to commit to mobilize more capital into ESG opportunities and be able to measure their impact, as well as deliver the returns that they're looking for. So those are the three projects I'll highlight. Of course, we've done lots of other things in between, but I think in terms of TCFD and certainly Greening the Belt and Road, those are big highlights, and I think big important projects going forward. I'll leave it there. Thank you.
Thank you, Simon. That's fascinating on all three projects there. On the final one, it segues quite nicely on stewardship into our final panelist, Bill Hartnett, who's ESG Stewardship Director at Aberdeen Standard in London. Bill's, you've all got his bio. I'm not going to reread it in full. I'll maybe let you introduce yourself, Bill, but and keen to hear your thoughts on Simon's final point around the prospect of and the potential value in drafting some kind of UK-China stewardship code. Whether you think there's value in pursuing that. I think you have to unmute yourself. Thanks.
I just did that. I took that trick. So good afternoon, everybody, and thanks very much for inviting me along to the panel today. I'll just make a couple of quick points, I think, because we do want to get a bit of Q&A going on. Certainly, we work with David. I'm based here in London. I'm previously in Australia, in superannuation funds in Australia. So I've just come over in the last year. And this whole area of ESG, I think David really summed up very well just how well China has been progressing in this area. And I suppose from Aberdeen's perspective, why do we look at ESG is, well, we think we get better investment returns from doing so, from understanding the risks and opportunities involved with ESG and how they link with companies. But you can get this really, positive spin-off that, institutional investors really need to see in terms of being a fiduciary obligation, and that looking at ESG factors actually can be part and parcel of fulfilling your fiduciary duties. And indeed, I think there's been something like 730 quasi regulatory initiatives going and formal regulatory initiatives since 2020 that has recognised that ESG must be brought into the framework of thinking for long-term institutional investors. So it's great to see China's coming a long way in this area, and it's needed, just like it is everywhere else in the world. And I suppose where we can really see some where we tie up with London and the EU is very strong, is that there are best practice that's happening over here in the UK and in the EU. And whilst China is increasing in its ambition, certainly you're seeing that in the UK and EU, it's all framed around commitments to the Paris Agreement to try and get to net zero in European economies by 2050, with the aim of limiting temperature rises to 2 degrees max, if not 1.5 degrees. And what Simon was saying about Belt and Road in China, just example by its EU regulation. Clearly we're investing all around the world, and the ability to work with our investee companies through Asia in China is very key to meeting those goals. So a few things that we've really been working on, and again, it's been mentioned before, so I won't say it for too long, but this area around TCFD, this is a G20 group that has championed this disclosure on climate change across all corporates, looking at governance, strategy, risk, and then risk and opportunities, and then targets and what you can do around climate change. The other areas that I'd say in stewardship that we've been looking at from an advocacy perspective has been things such as the EU taxonomy, which is an incredibly ambitious strategy to create a market for and greater consumer confidence that you can create a market for sustainable finance. So here you are setting up revenue-based criteria on what actually is a sustainable cement company, what is a sustainable power utility company, down to revenue threshold basis across, at the moment, 67 different activities of what is eligible for taxonomy and what isn't. And so we're having formal government intervention here to really set standards on what we see as sustainable capital deployment across all these areas and what isn't. And it gets very interesting from an investor's perspective. The taxonomy will be coming in from January 2022. It will be mandatory reporting for all EU funds, EU marketed funds that have sustainability or impact in their title, to see how much of their portfolios are aligned and revenues are aligned to the EU taxonomy. And so they can be funds, not just European sort of sustainable funds, but also ones that are in emerging markets and on China. So that creates a whole more incredible momentum in terms of needing to improve the amount of data and information that we're getting from companies globally, not just in China, but globally, for a whole level of new understanding of what companies are actually producing and how sustainable they are. The other areas, David spoke about our own engagement with companies in finance, in Asia. We have the work that we've done in financial holdings. Ping An is a great example of the leading asset owner pressing for ESG reporting standards in China and disclosure. We're seeing good stories in real estate as well in China, and indeed across all sectors. Climate change is a really great story of risk and opportunity, and you can really see that in some electric vehicles, telcos, as Dave was mentioning also. Just finally, I would say, well, a couple of things. Collaborative engagement is something that we're seeing. Initiatives such as Climate Action 100 Plus, which is using things such as the TCFD, but this is a group of 400 investors now representing over 40 trillion US in FUM that are engaging with companies, about 150 most significant companies globally, but including 30 odd in Asia. And indeed, companies such as PetroChina have been starting this engagement process on exactly these things. What are the risks and opportunities from climate change? How do they align to, the Paris Agreement? What sort of opportunities are you seeing there? So really, we're seeing, over in Europe, the oil and gas companies have really stepped up in terms of setting targets on very difficult issues for this sector. And we'd expect that this will go globally in smaller steps, but globally as well. It's inevitable that it will be. Stewardship Code, just quickly, yes, we've seen the UK Stewardship Code 2020 revision come out with a much more substantive and ambitious goal around stewardship. We're really seeing that the definition of an investor is changing from short-term profit maximization to long-term responsible allocation of capital to provide best long-term returns, but also giving this benefit for the economy, environment, and society. And I expect these sorts of things to continue. You are seeing all of these develop across different bourses around the world. And there's enough investor groups that would be interested in developing these and are doing it throughout Asia. So I would imagine that China would be a natural extension of that.
Thank you, Bill. That's, again, a really useful complement to what David and Simon have already opened up this discussion with. So I would like to just have I've got a couple of questions myself, which I'll fire into, but before that, just a reminder to any other participants on the call, please do pop your questions in the chat box, and I will endeavour to ask them in the 15 minutes we have remaining with our three panelists. David, the first one's for you. You touched on what the drivers were towards the end of your presentation, what the drivers were for the cleaning and greening of the Chinese economy. One of which was the fact that there are more global investors in China, and the other being Chinese government policy itself. I wondered, what do you think the impact of Chinese corporates going global themselves over this past 15 years has been on that, I guess, recognition of ESG and implementation of some of these principles in Chinese corporates that you've seen?
Yeah, I think that's a really great point. And it's something that I remember us having discussions when I was living in China over 15 years ago. We were discussing the impact or the potential impact of greater foreign direct investment into China on these kind of issues. And I remember that at one point the conversation pivoted to what the impact may be when Chinese companies go out in the way that you're saying. And I wish I was that smart to have made that observation. I wasn't, but it's something that stuck with me for many years, because it's absolutely what's happened. So as you've seen Chinese companies go overseas and expand, particularly inorganically, so pursue M&A, I think there's been a greater focus on Chinese companies, and we've seen this a lot over the last 15 years. And I think there are a couple of things at work here. One is just the greater exposure to other ways of doing business and other themes and other focuses from other jurisdictions as you work more with global partners, through JVs, for example, but also the increasing focus on Chinese companies as they've gone overseas as acquirers, and the need to present or the need to subscribe to what I hesitate to call, but let's use as shorthand, global standards of ESG as well. Investment is subject to some kind of a government board or foreign investment review board or whatever. But I think we've seen some acknowledgement that high quality ESG really helps with that process. So I think it's both components of that, but sure, you're absolutely right. That's a really important theme.
Thanks. Simon, you mentioned just briefly about the Shanghai Stock Connect, which has now been in force, I think, for just over a year. What's been the impact of that specific program on ESG between the UK and China, or that sharing of best practice? Is there any channels through that, now that you're seeing deal flow perhaps more from Shanghai into London and vice versa, do you think that's having an impact on ESG investment, or is it too early to tell?
Yeah, it's a good question. I mean, it's probably too early to tell, to be honest, at the moment. But I think it's building that foundation in kind of cross-border capital flow, but also as a complement, all of the stewardship, governance, and policy frameworks that we've talked about can only help kind of drive that conversation. As we started this conversation on China, remain extremely committed to greening their economy and greening their financial sector, as does the UK. So I think a marquee partnership like that, whilst in practice there'll be a lag for ESG practices to catch up, I think we can't help but see some cross-pollination of the best ideas. And I think that the thing that I'd perhaps highlight is the notion of transition-based investing, which is becoming kind of more prevalent in London's listed markets. Will be hugely relevant for Chinese opportunities, and we've talked about what it takes or what should qualify as a cement company, for example, which is not green today but has a credible plan, particularly in governance terms, to get to where it needs to get to, and the EU taxonomy can help drive some of that. But equally, the use of transition-based indexes can allow companies like that to raise capital, ones that are not green today, but are on a pathway, and give investors the opportunity to finance that transition is profoundly impactful. And I think will have a huge impact in China in particular.
And have we actually seen many UK investors actively engaging and taking advantage of these opportunities in some of the, you mentioned the Belt and Road earlier, other such sustainable opportunities that you've seen? Have we seen a lot of UK investors actually bite the bullet and get in there? And anyone want to comment on that? Has there been volume there?
I mean, from my perspective, I think the challenge is to open up the market to a broader suite of investors. I think as David and Bill have touched on, Aberdeen have been at this for a long time and invested a lot of money in China, I guess. And we've seen in Belt and Road opportunities and Belt and Road companies, obviously preeminent firms like HSBC and Standard Chartered, who've been active in project finance in some of these countries for a long time. I guess, particularly for BRI, the test will be whether we can get later stage in terms of project equity investors who are not yet familiar with the region getting involved and committing capital. That will be, for me, what success looks like, and we can build on the pioneering work of those banks and not least Aberdeen in China in particular.
Thanks, Simon. Bill, slightly left field, but in the existing context of COVID-19, one question that I had was whether or not, I think people have talked about Wimbledon having foresight in paying for infectious disease insurance for the last 17 years since SARS came out, and that's come good for them. In grouping that together with good governance in a sense, have you, and I think I've also read about Taiwanese companies quite often having experts in public health on their boards. Are we due to see a lot more of that going forward in China, but also in the West? Do you think that's something that we're going to see a lot of in light of this current crisis?
Yeah, look, COVID has been a really interesting case study. It is really just, I think, a similar sort of risks that you see with climate change, but and a much more acute and fast acting a dynamic in which it came across the world. And from that perspective, I don't think it's for us, it has really reiterated and reconfirmed the reasons why we're looking at ESG issues, because we're seeing structural problems in the allocation of capital within markets. And then something like COVID just comes along and just exacerbates those sorts of risks and opportunities. And we've been seeing also in how companies responded, whilst it has struck many companies by surprise, things like looking at pandemics, particularly in Asia, where we've seen epidemic outbreaks over the last 20 years, should be something that really strong boards are focusing on and looking at as a risk issue. So it gets back to us when we're looking at companies, and again, one of the reasons why you look at ESG issues, I was saying before, we see it as material. So how does it, link in with your own way of thinking? It does tend to help us. We have a quality focus in our investment, favouring companies that have stronger balance sheets, many sort of aspects around quality, full stop. And companies with good understanding of ESG and good ESG capabilities can act as a sort of a proxy on exactly those sorts of things. And indeed, you've seen, it's early days yet, and you want to think long term, but the performance of ESG funds during the COVID period were generally have outperformed your standard funds and benchmarks. And indeed, for us as an active shareholder, where we don't have to invest in every company, it's a very good time relatively for that, because you are able to exploit those risks by being overweight or underweight or not within a company. So you're certainly seeing COVID has really reinforced the reason why we're looking at ESG, but it's how companies are addressing it. I mean, you can have companies that are good quality, but that are better, more resilient to these types of risks. But you're also, another area that we've been looking at strongly is, the diversity of boards and how boards think about this. So it wouldn't be at all surprising to see, increased pressure on board members, maybe more in European context at the moment than in China and Asia, in terms of how they are being selected, what skill sets they bring, because the reason for diversity is key, and that we think it makes for better decision making. But you need to get a broader scope. We've been strong on the diversity element, and also on racial elements as well. But it's this diversity of thought. Full really stop. So yeah, I'd expect that we'll continue to see more of it.
Thanks. Another question in from a participant. I think I'll point it towards David. China is categorized as a developing country, and their primary goal is still to carry on developing their economy. Hence, could China push the energy consumption higher in the next decade? And if so, can British engineering companies help them to decarbonize their assets? How can British engineering companies help them to decarbonize their assets if they're still going to continue their energy consumption increase, really?
Sure. So I'll keep my answer brief in the interest of time, but as China continues to evolve, will energy consumption go up? Quite possibly, yes. We'll see energy consumption go up. But I think the really interesting challenge for China, one that it's really facing head on, is not just about that increasing power consumption, but the two themes around renewable energy. So where does that power come from, and also energy efficiency. And I think those are two themes that British companies, or any companies for that matter, but certainly British companies with an edge in terms of technology and something they can bring to that decarbonisation, I think that would present a number of opportunities for business in China, because there's an enormous challenge in China in terms of that decarbonisation and how the tension between decarbonisation and growth in energy consumption, and also the enormous opportunity that presents as well. So yes, I should think so.
Thanks, David. And Simon, another one for you. Does the EU taking greater interest in a green recovery make life easier in terms of speeding up agreement on a global standards framework, to include China in that as well?
I don't know that it makes things easier particularly, but it's there's a huge momentum and commitment from the EU on the sustainable finance package in terms of the taxonomy itself and related disclosure requirements. China has obviously had its green bond catalogue in operation for quite some time. And there are projects underway to link, for example, categories of Chinese green bonds that would also qualify under the EU green bond standard. So initiatives like that try and give particularly market participants one view of what counts as green are vitally important. So enthusiasm and impetus is good. We need to make sure that the market doesn't fragment and further confuse investors. The important thing about taxonomies is making sure they're interoperable for market participants in different jurisdictions. So there's only one exercise of compliance and ultimately do what they should do, which is provide reassurance to investors that they're getting what they want from their sustainability commitments.
Good answer. Thank you for that. I'm conscious of time, everyone. I'm really appreciative of all your insight on today's webinar. I don't know if anyone, if there aren't really much time left for any more questions, but thanks again to David, Simon and Bill for joining us this morning and this evening in Singapore. If we've got any more questions that come through from participants after the call, then we'll pass them through your way, if that's okay. It leaves me just to highlight a few upcoming webinars that CBBC is going to be running. We've got a premium roundtable on US-China relations with Craig Allen, President of the US-China Business Council, on the 2nd of July later this week. And then next week we've got CBBC Digital China webinar with Ernie, is China leading the digitization in automotive and mobility. And then much further beyond the summer, we've got the CBBC Digital China webinar with FinTech Circle, looking at FinTech investment post-COVID-19. As I mentioned before, later next year we will be engaging this topic in the next run-up to COP26 in its postponed format. But before then, please do just stay engaged and keep in touch with everyone at CBBC. And thanks again to all our speakers this morning, and have a lovely afternoon ahead. Thanks now.
Thank you. Thank you.